I mentioned top of the show, sort of our headline or umbrella debate is time to be cautious or time to be bullish. And I said emphatically, you are in the latter camp. You remain bullish, even in the face of, as I said, a number of people from Miner to Dwyer to Krinsky to Reader who say, you know what? I don't know. It's either euphoric, it's either overheated, it's either frothy, it's either going to be volatile, it's either going to be turbulent. And you say we could get to my $4,400 price target sooner than expected, and there's a 50% chance we reach it before the summer.
That's right. Scott, I heard all of the comments earlier in the show. The stock market stalled really in the past month. It kind of coincided with COVID cases in the U.S. not improving, and then, of course, the outbreak in India and the lockdowns in Europe. And many sectors went through deep individual corrections. Now it looks like U.S. COVID cases might be legging down in a big way because we're hitting that 40% vaccine penetration, which coincide with Israel seeing a huge leg down in cases. And I think it started 2 days ago in the U.S. That means the June reopening, the visibility on the U.S. sort of coming out of this is much stronger. And I think stocks are going to now have another leg up. So I think the rolling correction is sort of running its course. And yeah, I think easily 4,200 in the S&P, but maybe as much as 4,400 by June. So I think we could have a real rejuvenation of the stock rally. So calls of a 10% correction, you've heard them on this network. You've probably read them elsewhere, too. You just think that's not going to happen? I mean, there's a lot of valid reasons to think about that, but there's been so much deleveraging. And as you guys point out, the interest rate environment's really stabilized. I don't agree with the idea of economic momentum peaking is stock market peaking. I mean, for instance, from 1982 to 99, that's 17 years. If you cut that exactly in half, the equity market compounded at the same rate the first 9 years and the second 9 years. And economic momentum, I mean, when did it peak? It must have peaked at in 1984. So, I mean, you had 17 years of literally the same compounded returns. I think that's a setup that we have today. So I think investors are correctly cautious because COVID really was stalling and rates were uncertain, but there's been so much deleveraging. And we've already seen things like SPACs and the hypergrowth stocks correct. I mean, everything's corrected at different times. So I think we're done with the correction. But how much of the good news is already in the market, do you think, even with this consolidation period, albeit minor, that we've gone through? I don't think a lot of good news is priced in, Scott. Just to give you an example, a steel company, Cleveland-Cliffs, reported this morning, and the CEO could barely contain his notion that even if you haircut where things stand today, they're going to beat full-year numbers by a substantial margin. There's a lot of operating leverage that'll take place this year because the top-line environment was so restrictive for the past year. It's now starting to open up at a time when companies are really lean. I don't think most people have modeled the kind of rebound in EBIT that'll happen. If we just look at it at the sector level for the cyclicals, they might be by 2022 more than 100% higher than 2019 levels on using consensus revenue estimates, but 2008 operating leverage. So in other words, if you just use an old playbook, they're going to crush numbers for the next 2 years.